Welcome, everybody, to the first interim Public Pension Oversight Board meeting. And before we get started, I'd like to call the roll. Secretary, please call the roll.
Senator McDaniel. Senator Mills.
Here.
Senator Neal. Senator Parrott. Senator Wilson.
Here.
Representative Graham. Representative Petrie. Representative Tipton.
Here.
Representative Weber.
Here.
Representative Wheatley.
Here.
Joseph Fons. Mike Harmon.
Here.
John Hicks. Sharon Mattingly.
Here.
John, was that you that said here from abroad?
Yeah, thank you, Representative Plessy. It's John Hicks. Thanks.
Okay. And just for the record, we are no longer allowed to accept not in-person testimonies or voting or anything. Yeah.
Attendance.
Okay, thank you.
Sharon Mattingly. Representative Miller. Senator Higdon. Representative Duplessis.
Here. Thank you, Secretary. And first, I'd like to just ask for approval of the minutes.
Second.
So moved. And if we could, we'll just get right into it. And right first on the agenda would be Mr. David Eager to give us an investment update. So, David, the floor is yours. Please announce who you are and who you have with you for the record.
I'm David Eager. I'm the Executive Director of the Kentucky Public Pensions Authority.
John Chilton, CEO of the Kentucky Retirement Systems.
Ed Owens, I am the CEO of the County Employees Retirement System.
And thank you, gentlemen. You may proceed.
Let me clarify something if I could, because I understand maybe the rules have changed and I wasn't aware. We have Stephen Herbert, our CIO, on this Zoom call. He was going to do the investment portion of this.
And I slightly misspoke when I spoke. You are able to do your testimonies from
Okay.
afar, but being counted as present or counted as a vote cannot be done unless you're here. But you can go ahead and give testimonies. That will be not a problem.
All right. Stephen?
Yes. Hi, Stephen Herbert here. Hopefully everyone can hear me.
We hear you fine.
Thank you.
In that, Representative Plessy, in that 2-minute pause, I was I was scrambling to say, all right, here's what I'm going to talk about in the investments. That's okay. This is our agenda, and this is, I think, the first time that the three of us have been at the table, but we've evolved after 484 to saying some of these issues are CERS issues, some of them are KRS issues, and KERS, the two funds, and the state police, and some of them are KPPA. And so when we get to talking about things like ESG, that's really, the policies really come out of the individual boards. That's not a KPPA issue. So Ed and John are going to speak to that. I'll ask, and Stephen's going to talk to investment performance in a minute. I will tell you, I'm hoping for a positive year. We had a year 2 years ago that was 1.15, and then we had a nice all funds 25%. It looks like we're going to be back closer to what we were 2 years ago. Ergo, the benefit of smoothing, the 20% smoothing that the actuaries use, so we're not getting all this volatility passing through. We're going to talk about asset allocation. C has made a new allocation since we, I think, last presented. Stephen's going to talk about where we are now and how we're trying to move toward getting to our targets and some of the things that are impeding that. ESG, as I said, John and Ed will talk to that. Proxy voting, Stephen will talk to that. That's a kind of brief comment. And I would note that in your packet you have copies of the C and the K proxy statements. We'll talk more about that. And then the question was, what was the impact of the 8% salary increase on the retirement systems? And we have data on that. So Stephen, I'm going to let you, I don't know if you want to make any introductory comments before you get into it?
I do, if I could. First, let me say there's quite a few slides here. I don't plan on presenting to all of them. Some of them will be reference slides. So we, towards the end, we'll probably slide through those if there aren't any questions. And I'm, as Mr. Eager said, I'm here to talk to you today about the return update. And we've got preliminary numbers through the first quarter, calendar quarter, and also asset allocation. In terms of returns, what you'll see is both the equities and the bond portfolios are experiencing negative returns year to date, calendar year to date. So you'll see where that is a negative drag on the portfolio, since that is a large allocation to both of those asset classes in this portfolio, or all the portfolios, excuse me. And then asset allocation itself, we're really in a period of transition, a mini transition, if both deliberate and involuntary. The deliberate piece is, as Mr. Eager said, an asset allocation change with the county employee retirement system. We also had a liquidity event by us moving away from an investment manager, which had a 60-40 style portfolio, 60% equity, 40% bonds earlier this year, and caution. We are moving towards an allocation for CERS that is a few percentage points higher in the public equity space. We have gone very slowly towards that from late last year when it was changed, due to our the perception of future market volatility in especially growth stocks, but stocks in general, with the Fed coming in to raise interest rates. That turned out to be a good decision, so at least we've done no harm there. In terms of involuntary on the asset allocation, there were a couple of plan secessions which increased the cash in the Kentucky Employee Retirement Systems plan for non-hazardous, and COVID, frankly. Much of the allocation that we've been looking to increase has been real assets. And from that standpoint, it has been, especially last year, it has been very difficult to invest in real assets, given the restrictions, just in terms of business operations for those managers. So on to the slides. So what you're going to see here is preliminary data through 3/31. This is a combined look at the plans. So I've broken it out between the two. So this is the pension plan for CERS and CERS hazardous, excuse me. So the top line is the results for CERS, non-hazardous. You'll see the market value, the month return, and this is calendar month, 3 months, and then your fiscal year to date. So you'll see the big negative number, or the bulk of the drag down for the 3 months with the negative 3.16%, and your fiscal year to date, just over 1.4%. So that next line is the plan index.
Oops, sorry.
I'm going to go quicker. I just wanted to read through these numbers so you'll see it back to the original slide. So the next line is the plan index. So that is really just the beta, if you will. It's the index returns of the benchmarks, which are in our asset allocation. And we'll talk about asset allocation below briefly. But then you also see the C hazardous, same return lines. And then graphically, you've got a couple of asset allocation graphs, one showing the actual allocation in the middle, and on the bottom, you can see the relative weights. And I've broken these relative weight slides out into a bigger graph. We've enlarged them so we can discuss that when we get into allocation. So the next slide is the Kentucky Employee Retirement System slide. So the combined returns, combined allocation with each of the plan returns. So you can see there the negative returns for the 3 months and slightly positive for the fiscal year to date. A little bit better return for fiscal year to date for the hazardous plan, but a little bit worse return for 3 months, and that's due to the higher equity allocation. The next slide is the insurance plan. So you've got CERS, hazardous and non-hazardous broken out. Very similar returns because of the same asset allocation. And then the next slide is insurance for the Kentucky Employee Retirement Systems. So again, very similar returns with the same theme of a negative 3-month and slightly positive fiscal year to date. So here are the enlarged slides coming up. So this one is the total of all of the plans in KERS for the pension system. You'll see there that this gives you the 0 being the actual asset allocation, and then a negative bar going to your left, which means it's under allocated, so you would need funds, and the positive bar going to your right would be over allocated, so you need to reduce funds. So as you can see, the cash that I was referring to, a bit cash heavy, a bit fixed income heavy, and then those assets are to be invested in the real return and real estate allocation, which is underweight.
Stephen, if you don't mind me commenting, we don't have to be on that center line. I mean, we can decide we want to be underweighted or overweighted. We just have bands that we have to stay within. So some of this can be intentional.
Just a minute, Mr. Eager. We have a question from the co-chair.
Okay. When we look at the allocations, and they are kind of they deviate, somewhat from the goals that were set out. Did we come out better, or did we come out worse in this deviation from what the goals were for the allocation? What we set back in, I guess, last year, target allocations.
Well, year to date. It's kind of a wash. You've done better with the cash, but you'd have been better off with more real assets.
I think
for the Kentucky Employee Retirement System plan.
K non-haz would have been favorable, and C non-haz would be unfavorable.
Okay, thank you, Mr. Chairman.
Modestly for both.
Yeah,
yes.
In terms of the impact. A little more for C than K.
Okay. Representative Tipton.
Thank you, Mr. Chair. While we're talking about allocation, we're experiencing very high inflation now. The Federal Reserve has indicated they're going to be raising interest rates, I think, substantially. How will those factors impact your allocations in the near and the long term?
Thanks for that. Good question. We, as you would imagine, we have been focusing on inflation, and that is where we're putting the assets to work in real return and real estate, real return especially. We do have some inflation protection specific portfolios like Treasury inflation protected securities tips. And also within the private infrastructure, there are CPI CPI adjustments that go on with those leases, for instance.
I think, too, Stephen, you can back me up on this, but the duration of our fixed income portfolios tends to be shorter than the market.
It's short, right?
Yeah, so we're going to be less impacted by rising rates.
Good point. We did shorten the duration due to our anticipation of raising rates, and that has helped tremendously.
Thank you.
Sure.
Please continue.
Thank you. So the next slide is for insurance. You can see a similar story. So your overweights to cash, fixed income, and especially credit, and your underweights to your real assets. Slight underweights to some of the other asset classes, but nothing that the market isn't making move in terms of the equities. And then the pension weighting is really, as I said, due to the new asset allocation. So you see much higher differences because of the new allocation. So in that allocation, real return was increased. Therefore, we have a bigger underweight, and specialty credit was decreased. And that has not occurred in actuality yet. And I can better explain that when we get to those slides. But this is the cautious rebalancing to the new target that I spoke of. And then the same story for insurance. So if we could skip through these to asset allocation, these are the previous quarter returns. I'm happy to review them if anyone has any questions, but it's also the previous quarter's asset allocations. which is a very similar story to what I just told about this quarter. So I believe there's an asset allocation section over the next few slides.
You want me to go on?
Real quick,
Oh, yes, please. I'm sorry, David. There's a whole nother section.
what percentage of the portfolio is cash? And is it growing in KRS non-HAS?
KRS non-HAS is, I have that.
Stephen, well, he's looking for that. Stephen mentioned earlier two events. One was Northern Kentucky University and Kentucky Housing paying off in total about $230 million, $240 million. And then we terminated a manager that had, I'm going to say, between $800 and $900 million. We've gotten the cash from that. So there's two huge infusions of cash in a short period of time recently.
For K non-HAS, for sure, yes. Yeah. And that's roughly 14.5% in cash. Your upper band there is, your upper IPS max there is 10%. So that's an action item we are working on bringing down below the upper band.
The upper band was 10%, you say?
Yes.
Okay. Mr. Miller, Representative Miller.
Thank you, sir. On your after allocation study pages, you don't seem to break out U.S. from non-U.S. equity. Was that intentional or just an editorial streamlining?
And it was intentional. Why don't we go to those slides, Dave? There's a few more down. Keep going. There you go. So this is the CERS. I started here because that change has occurred. It was as of December 1st. So the before had the as you mentioned, Representative Miller, U.S. and non-U.S. broken out specifically. The decision was made to bring that together and make it a public global equity allocation. So it went from the adding the two together, the 43.5% to the 50%. So that is now a global portfolio as opposed to a distinct choice made by breaking those two out.
And that's the way you'll manage it going forward?
Yes, sir.
Okay. Thank you, Mr. Chairman.
I think a lot of the thought is that so many of these countries are multinational. It's really hard to say. Is this a U.S. company or a foreign company? What's driving it?
Correct. And it doesn't require us to get any new global mandates. So we were managing the international and the U.S. together as a global mandate. We could get a global mandate with an outside active investment manager, but there's no requirement to do so.
So getting back to where I was at a minute ago with the cash allowance percent and the percent of cash in the portfolio, it's going up every year or every quarter. We're above our allowable now, and cash is a good thing when your market's dropping, so it's not necessarily a bad thing. But what are your plans for that? Since you're kind of outside of the allowable already, what are your thoughts and plans for that?
That cash is going down to, I say down because it's below the equities. It's going to real estate and real return. We are currently, we have 3 searches going on. One's for real estate, obviously. One is for to look at commodities for inflation protection. And the other one is looking at infrastructure for inflation protection. Those are currently ongoing, and we'll have money allocated there as we choose those managers, but it's also being allocated through capital calls on some of the real estate portfolios that were slow to take the money last year due to COVID.
Yeah. And we just don't normally see you get this far out of balance. And I guess I'm just kind of wondering, when do you foresee bringing this balance back in?
We're currently investing the assets as quickly as we can into the asset allocation to bring it within the ranges.
Okay, thank you.
So the next slide shows you the KERS version of this. So starting with non-HAS, this takes effect on April 1st this year. But this is a similar move to to consolidating the global equities, but nothing else. There has been no asset allocation change in terms of the numbers. The ranges got cleaned up slightly, but it's the same allocation. And then the next slide is KERS hazardous, I believe.
Sorry.
Yes. And insurance. So again, same allocation percentages, but again, just the move to the global public equity.
Yeah, good. I was just reminded that people might not know what TIPS are. They're Treasury Inflation Protection Securities, where the return is linked to the inflation rate, adjusts up and down with inflation. Stephen,
and that's all I had. I can take more questions.
Representative Tipton.
Thank you. On your asset allocation pages, you changed some terminology in the after allocation study. You went from high yield / specialty credit to specialty credit with an asterisk. Could you share a little bit about the types of investments that are included in specialty credit?
Yes. So high yield is still in there. So you have publicly traded and private high yield portfolios. You also have your private credit or loan portfolios. That's basically what makes that up.
Could you give an example of a private loan, Stephen?
Sure. We may have so for instance, there may be private asset-backed loans, and the asset underneath it could be anything from airplanes to, certain types of cargo, things like that. Where high yield would be on a company that has a debt rating, publicly traded bond debt rating below BBB, to keep it with one rating agency.
Okay. Got a quick follow-up, Mr. Chair. Of your portfolio and your allocation, could you just share with us which ones are more secure and which ones bring higher risk?
So it's easier to answer if you take the old asset classes. So you can see where the growth is in the part on the left. That's your high risk, and then liquidity is your low risk, and then diversifying, which we're now calling inflation protected. There is risk there, especially when there's no inflation. But yeah, it's slightly more than liquidity and slightly less than growth.
Representative Tipton, there's also different types of risk. Inflation, interest rate risk is one. Default risk is another. So they could fall into any of those categories. True,
and you have to forgive me. I default to volatility as risk. And as you've seen, the public equity markets this year are highly volatile. And the other thing I should have pointed out as well. So that's true. We did change some of the nomenclature on the asset allocation. We did it for the asset classes as well. So we've gone to a more traditional, from growth, made it equity, liquidity became fixed income, and diversifying became inflation protected in both CERS and KERS.
Representative Wheatley, did you have something to add?
I have a question, Jim.
Yes, please.
This can be for the director or whoever answers. It seems like we had in the past asked that we'd see 30-year reporting. As our tables show us, we stopped there at 20 again, and also the question actually is the last column is an acronym that I don't recognize. Is ITD, and just to see what that is.
That is inception to date. And I believe, don't quote me, I believe that's 1984.
So there's excuse me, the follow-up. There's 4 of these charts, and there are a number of plans, and I don't think they're all the same inception to date time frame.
They aren't. Yeah.
They're not.
It'll be from whenever that started going forward, and there'll be different timeframes. And I'll take responsibility on the 30-year. We were relying on schedule that we had readily available, and my fault. It didn't take the time to recalculate and put the 30-year. We can do that and send it to you.
Yeah, please get that to the committee.
Yep.
Question: How, as interest rates go up, how do you foresee that affecting the pensions funds? Do you see that as a help, as a hindrance? Because my understanding is historically, when interest rates go down, it hurts pension systems.
If interest rates rise in the short run, it's going to hurt because the assumptions won't be adjusted that quickly, and anything that's interest sensitive, any investment's going to hurt. In the long run, it probably is. We're going to find out that the assumptions would go up. The interest assumptions most likely would go up as interest rate go up, and the liability is going to go up. The benefits are going to be more costly. So,
okay, thank you.
I think the real key in the short run is going to hurt.
Okay. I see no more questions. If you want to continue on,
we're going to change topics now.
Yeah, again, my name is John Chilton. I'm CEO of the Kentucky Retirement Systems, which has 3 plans: Kentucky Employee Non-Hazardous, Kentucky Employees Hazardous, and the State Police. Before we start the discussion on environmental, social, and governance, I'd like to thank both the House and Senate members for the support that you've given this year for fully funding the pensions, the additional money that's going into the K systems, and especially for the money that's going into the state police. The recovery period for all of these plans is extremely long, and this goes a long way in that direction. So thanks very much for that in the current year budget. The environmental, social, and governance refers to reporting that will be enhanced over the next few years. It's really a worldwide trend towards significantly increasing disclosures of ESG-related information to investors. The initial focus has been on environmental issues, the initial focus and the initial discussion, with social and governance issues coming later. Publicly traded companies, including businesses doing business with those companies, and investment advisors and managers will be rated on metrics associated with ESG issues. To further understand the ESG components, environmental, well, this is the social slide, has to do with community relations, diversity, equity, and inclusion, employee health and safety, human capital development, labor management, privacy and data security, product quality and safety, and supply chains standards. The last component here, the governance, is anti-bribery and anti-corruption, board composition and elections. There's going to be a lot of focus on the composition of the board under this metric. Business ethics, corporate resiliency, diversity of leadership, executive compensation, lobbying and political contributions, ownership structures, and tax transparency. Do we have the list on the environmental?
I don't, but I think this speaks to environmental here, I think.
Okay, we had a slide in there that had a similar list on the environmental. The KRS Investment Committee has been talking and learning about the ESG issues for a long time, and we're going to show you the statement that they have in response to that. The Securities and Exchange Commission on March 21st, just a little over a month ago, issued proposed rules to enhance and standardize climate-related disclosures for investors. These rules do not include issues related to social or governance. The disclosures will relate to short-term, medium-term, and long-term climate-related risks. And this is the quote from the SEC's proposed rules. It will be those climate-related risks that are reasonably likely to have a material impact on the business, results of operations, financial conditions, and certain climate-related financial statement metrics in a note to their audited financial statements. I would think that there will be much disclosure in the notes to the statements, and perhaps even some adjustments to the liability section on the balance sheets. And it's looking at short-term, medium, and long-term disclosures. Now here's a significant part. The SEC reporting rules include environmental issues for upstream and downstream activities in its value chain. That means that the SEC disclosure will include information in compliance with the metrics of its customers and its suppliers. So it's not just the big publicly traded companies, but any customers that they have and the suppliers. The companies will be requiring information from these customers and suppliers in order to consolidate it into their reporting. The initial reporting is expected to begin in 2023, with reporting requirements expanding in the future. This is what I've just described is pretty much a generic view of ESG, but here's the Kentucky Retirement System's perspective onto the ESG issues. As I said, the investment committee and the board are aware of the changes that might be forthcoming on these issues. And if you look back over the years for the development of generally accepted accounting principles, GAAP, those are occurred over a very long period of time and continue to occur and evolve. In February of this year, prior to the SEC's release of their proposed regs, the investment policy statement was amended to include a paragraph which is shown below. The policy focused on the financial considerations and will continue to be clarified in the future as guidance is revealed. The committee really looks at this as an additional risk to be evaluated in connection with each company. That's the way the managers will look at it. It is a business risk that needs to be. The policy statement is the third paragraph there. Maybe it's on the next page here, I think. No? Okay. The policy statements, it basically says we're aware of ESG issues and the fact that it affects our businesses, the profitability, the sustainability of those businesses, and they'll make investments in that context. So until things develop in a more specific way, the policy statement will be amended in that way as well. As an accountant, I can envision the development of metrics for different kinds of businesses as it relates to the environmental issues. I have a much more difficulty envisioning metrics to create a scoring system for the social component of it, and maybe even the governance. So there's a lot yet to be known about this. There are many organizations around the world who are in some ways competing to be the standard setter with these issues. There's a lot of that's yet to happen. So that's the Kentucky Retirement System's perspective. So Ed, I'll hand it off to you.
Mr. Chairman, thank you for the opportunity to come before you and to speak to this committee, to this board, about CERS's perspective on ESG. Before I get to that, I'd like to just make a couple of general statements to say that the County Employees Retirement System Board has now been in force for a little more than a year. In that time, we've made great strides under the leadership of our chairman, Betty Pendergrass, and our vice chairman, Jerry Powell. Much of what Stephen spoke to in terms of the change in the asset allocation for C has been driven by our board as we look very closely and very intently at what we need to do moving forward. It was mentioned earlier that we had redeemed about $900 million from a manager who had a portfolio that mirrored what we were doing in equities. So we were actually overweight what we were doing in equities. So we redeemed that back so that it could go to inflation-protected assets. And that's what Stephen and his team are doing for us now. But you're to be commended, because we would not be able to move as aggressively forward as we will be without the passage of House Bill 297. You gave us the ability to hire 4 to 6 additional investment staff people who Stephen will utilize to implement the cash that he's been given back and to start TIPS programs so that we're bringing more in-house than we've ever been able to do in the past. That's a huge step forward for us. We're excited for it and excited to have been given the opportunity by you for that. Now, as I speak to ESG, I really prepared my slides not so much for you because you know everything that we've done here, because you promulgated much of the legislation that I'm going to speak to. So it really is prepared for people who are watching who may not know the standard that the trustees have to abide by when they look at issues like this. And I wanted to be able to give those individuals a perspective of that. Okay. 26 U.S.C. Section 401A from the Internal Revenue Code establishes requirements for establishing a qualified trust, which is what we have. The General Assembly established, I believe, K in 1956, established C trust in 1958. Typically, 401A is utilized by government agencies, universities, and nonprofits. Typically, they are multiple employee plans. It establishes the fiduciary responsibility that the trustees and some selected officers have when they administer the trust. It says that we have to have, and the interest of the trust must be paramount, and there must be no competing interest. That's what the trustees have to abide by, and certain officers, as we do the business of the trust. It has to have an undivided loyalty to the members and to the beneficiaries. You codified that, the General Assembly, in 782 when you said specifically, notwithstanding any other legislative intent, that you were confirming that the federal statute or regulation, in order to meet the qualifications needed of 26 U.S.C. Section 401A, needed to be followed. So that's just one example of how the General Assembly has codified that federal statute for the establishment of our pension plans. The federal courts have agreed as well. The 6th District says that every trustee has to have an eye to the interest of the participants and the beneficiaries, a single-minded devotion to the plan and the beneficiaries, an exclusive purpose. So it's very clear from the legislative body and from the judicial body what our focus as trustees and officers needs to be. With that as a backdrop, I'll say that on November 10th, 2021, the CERS board, after much deliberation that occurred several times in our investment committee and at the board level, we adopted an ESG policy. And I'll direct you to the last sentence, and it's very similar to what Kay adopted. The overriding consideration of every trustee must be that we invest to maximize the long-term returns to the plan's beneficiaries. Okay. I included this statute because, again, it's evidence of what you've done and how you've helped us remain focused on what our responsibility must be. So in KRS 78790, and there would be a similar section in Chapter 61, the board, in keeping with its responsibility as the trustee and wherever feasible. So you're clearly saying that we must keep with the responsibility that we have to have a single focus for the plan beneficiaries. And when we can do that, and when it's feasible, that we would then look to develop opportunities within the Commonwealth of Kentucky. Dave. I wanted to put this slide here. It's not a big topic today because there are so many things in ESG that have to be formulated. It is at the very beginning of its road of what will happen in this space. As John mentioned, there has been very little discussion about the social or the governance aspects of ESG. All of what's happened thus far has happened in the space of environmental. And the only places where that really has coalesced has been in private markets and in international markets. We have private market exposure, we have international market exposure, but it's not necessarily significant. But we keep an eye toward making sure that what those managers are doing in that space, that we are aware of it, and the board will discuss it to determine that they can move forward keeping with their responsibility to the beneficiaries. We've just had very brief, very 30,000-foot level discussions about divestiture. And it's the general consensus that we've got to stay at the table. We've got to be in a position where our voices are heard. And anytime you say, I'm pushing my chips in, I no longer want to be involved, your voice can no longer be heard. We're focused on the long-term investing, the long-term perspective for the beneficiaries of the C Trust. That's what each trustee will continue to do, and that's what I will do as the CEO.
That'll make a nice segue to the proxy.
Real quick, we have a question from Representative Miller.
Thank you, Mr. Chairman. I don't know if this is going to be a question or a
statement.
A statement, But I really appreciate you all addressing this here, and I think, Ed, your slides have been really excellent in terms of getting this to the point. We don't know where this is going to go.
Yes.
I mean, you've got we probably, between all your plans and you throw in TRS, we probably got investments in 90% of the companies in the U.S. and 70% of the companies in the world,
Yes.
the bigger companies in the world. And all that distills down to, well, then you've got investment managers. Are investment managers going to have to report on their ESG performance?
Yes.
And then by the time you get down to the pension plan level, I think what you've got here is exactly the salient point. Is it's our beneficiaries, and it's the state we have an obligation to. And I would say to my colleagues that every now and then we face a bill that's been filed, whether it's to get out of Russia or Israel or South Africa or energy companies or only to invest in Kentucky companies. You see that, and we have to, as a legislative body, focus. This is about the beneficiaries. It's not about how we feel about this topic or that topic.
Yes.
Because you go into your one of your slides, on the 6th District slide on page 26, an unwavering duty to act as a prudent person. Well,
Yes.
tell me your politics, and I'll tell you what avenue, what realm of prudent you're on.
Yeah.
Because it's just, I don't know. It could get very, very confusing,
Yes.
more confusing than it already is. And I think you've done a great job of trying to focus the body on this topic. So I just want to say kudos. I don't really have a question other than I don't envy the boards trying to keep on track of this,
Yes.
but I know you'll do a good job.
Auditor Harmon, former representative.
Former representative. Thank you, Mr. Chairman. And thank you all for coming and bringing this information. I know I'd expressed some concerns last time, and certainly appreciate you all putting this package together. I do have a couple of comments and just a quick question, and probably a little bit more of it be directed when we get to the proxy part. But I know there was mention that there was an SEC proposed rule. My understanding is that's being challenged, and there's some concerns with that as well. And then it's my understanding there also the duty of loyalty on the federal level. There was some concerns that there was an attempt by the current administration to make changes to that as well. I don't know if you all would like to comment on that or how much you're aware of that. Or
Aware of it, Auditor Harmon, but would not want to comment on things that are in the courts or in the political realm.
Sure.
We certainly will watch it and see how it unfolds.
And I know some of my biggest concerns, of course, a lot of this is starting to surface. It's probably been going on for a long time, but a lot of it starts. So I've been hearing some things that are concerning, such as like BlackRock using proxies to take over Exxon's board and then start to divest. I've heard companies that are being anti-U.S. fossil fuels, but yet going and investing in China. Hopefully we are reviewing, and when we get to proxy, I'll probably have another question, but hopefully we are reviewing how our funds are being invested and how our proxies are being utilized.
Yes.
But I will have an additional question once we get to the proxies. Thank you.
Okay.
And Senator Mills.
Thank you, Mr. Chairman. My question goes right along with the proxy question. I think you may answer it here in a little bit, but have y'all looked at Senate Bill 205 that has to do with the treasurer coming up with lists of energy boycotting companies? And have you thought about how that will affect your practices? The intent of the bill, once again, goes back to not harming returns of funds that you're invested in. But and you don't have to answer it right now if you hadn't looked at it. But in the future, I'd be curious how y'all plan once the list is formulated how you plan to react to that.
Yeah, I would say one thing, but these two gentlemen are more involved with policy. It's not the first time we've had a bill that dealt with it. We've had Israel boycotts, and we've had Sudan, and a number of things that, to Representative Miller's point, are not, if you act on those solely, that's not necessarily in the benefit of our plan participants. I don't know if you want to add. Yeah, I think I just say kind of the bottom line how this has evolved. I mean, every issue of Pensions and Investment magazine probably has 3 articles on ESG. 15 years ago, you wouldn't see one. 20 years ago, but it's really evolved from forcing elimination of holdings for a variety of reasons: alcohol, guns, carbon, a variety of things. It was you can't hold those. Now what's happened, how it's evolved now, it's not. We're not away from that yet, not by any means. But how it's evolved now is to say, take these ESG factors into consideration because they may affect the outlook of the company, the financial outlook going forward. So be mindful of things that might be happening.
And I appreciate your testimony on it, and I think it makes sense what you're doing. But I think we as a people need to be really concerned that forces that are not elected are making policy decisions that affect how a company does business. Yes. Social constructing is what this is. So if you want to get away from guns, you can force people not to use to financially support gun companies. If you are against any number of things, I mean, this is a really big deal that I think people need to pay attention to. And I think you're right. You need to be thinking about what's best for your members. Yes. But it's a big deal when you can start socially constructing our society using a financial hammer. And it's not a good thing. It's just not a good thing.
We are now beginning, by the way, to see pushback.
Good.
Or organized pushback to that movement.
Good. Switching gears a little bit, I think was it Senate Bill 2 that required monthly reporting? Where are you guys at on your monthly reporting, getting that on the internet?
I think, and Stephen can chime in here, I think Senate Bill 2 actually required quarterly reporting, not monthly.
Okay.
We do put a report up every month. But on a quarterly basis, there may be more comprehensive information that's put up.
Okay, so it's going up. Okay.
Yep.
Thank you.
Proxy, do you want to go to?
I'm just looking to see, make sure there's no other questions. Please proceed.
Yeah, Auditor Harmon at a recent PPOB meeting started asking me about proxies, and I said, I may not be the best person to answer that, but also it's probably worthy of a more in-depth delve into it. I would say this, that both boards, K and C, have proxy statements. They're in your packet. And in general, they'll talk about the position on, are we in favor of or against particular votes on particular things? And I'll let Stephen chime in on that.
Thank you. One correction as well. The inception to date return numbers you see in your packet, the ITD, that's 1987. Not 1984. Apologies. Freudian slip. So a few bullets on proxy voting, and then, of course, we can answer questions, and if we need to go to the policy, that's fine as well. So as investors, we are voting. We have the ability to vote on our publicly traded shares, and there's different processes for different companies. So as mentioned before, we own quite a few companies throughout the globe. So we do hire a proxy firm to do that on our behalf. So each board does recognize that they can vote on these, and they have the policy posted to the website. They're also with both boards now currently being signed. And we currently use ISS as our proxy vendor. And they cast the votes according to our policy that we've given them, much like an investment manager would manage money according to the policy that we give them. That's it in a nutshell. Happy to talk about, where some of this lies in terms of how they vote, the proxy on our how they vote on our behalf as proxy. But it's, as Mr. Eager said, it's fairly straightforward in terms of how the board whether or not they're going to vote with management on certain things, and how the board makeup how the board is made up at each of these firms. And then of course there's you're just attending the meeting itself.
Auditor Harmon, did you have?
Yeah, thank you, Mr. Chairman. And once again, I appreciate you all speaking to this. A couple of questions. One, I know you've got a proxy statement. How often do you all monitor that they're voting in compliant with that statement? Does the statement make any known comments regarding is it just financial, or does it make any additional comments in reference to any of the ESGs? And finally, are our proxies being used? Well, I guess third and then fourth, are our proxies being utilized at all to take over boards? And finally, do we have, and we're from a proxy standpoint, if it's something that we don't have a comment on one way or other, do they automatically vote neutral, or do they vote with the board leadership, or what is the stance on those? I know that's a lot. Sorry.
That's okay. So the votes are monitored. It's very similar to the way we monitor the portfolio, on a periodic basis, quarterly basis. The only thing that would get relatively close to the ESG would be something called our social and policy issues. It's a brief statement, basically talking about the conduct of the company. Is that going to harm profitability? Any sort of conduct, indirect or direct. If there's something being discussed and voted on in that nature, it would need the board of directors approval, and we take the position of management there.
Okay, so the position of management. Okay,
yeah.
And then I guess just finally, from a standpoint of the proxy votes, if they are not voting according, is there a, for lack of a better word, escape clause to move them to somewhere else?
If
in breach of contract.
If ISS is not as a vendor does not live up to our expectations or breaches contract, is that? Oh yeah.
Yes.
We would just go out for a bid process and get a new vendor for that.
So we're not locked into a 1, 2, or 3 year, or however, if they're not being consistent with the goals of the state and to the investments to make sure that profit is as much as it can be from the standpoint of protecting the taxpayers and protecting the pension holders, then you could move forward with a different.
Every one of our agreements has the out clause if there is malfeasance. I'd have to get specific on this one. I haven't looked at it lately, but yes, there is that ability to do so.
But is there a fine line between malfeasance and just disagreeing with the policy of the board?
No, it's a pretty broad line there. Disagreeing with the policy, you mean actually not fulfilling their duties to.
What if they interpret what the statements that you all have made different from with the way that you all interpret them?
If they continuously do that on a sort of deliberate basis, then yes, that would be grounds for changing administrators.
Okay. Thank you, Mr. Chair.
You're welcome. And let's try not to machine gun our questions. If we,
apologies.
It's okay. Just let's everybody stay along if we don't.
I would say, by the way, that ISS, if they're not the leading firm, they're a leading firm. They're quite used quite prominently.
So Auditor Harmon was going along. Some of his questions were really what I was wanting to ask. And is there some metric that is being used to make sure that the proxy votes are in line with us? What is that metric? How are we going back and double checking to make sure? Are we spending that effort to make sure they're doing what we would, as a group, want them to do?
They report the votes to us, yes, and we can certainly pull that down and take a look at it like we do the returns.
But I think I'm asking, do you have a process in place to make sure, because I'm sure that's a lot of information to try to figure out, do you have a process to make sure they are doing what you would want them to do?
That would fall under our compliance process, our investment compliance. And yes, but like any process, we can always enhance it. I'm happy to have a look at it and report back on it.
It would probably be a good idea for this committee to understand, how that's happening and how make sure that our interests are being properly.
Sure.
Yeah.
It's a reporting function from the administrator to us, and then I can get some details on that for you.
Okay, thank you.
Okay. All right, move on. Our last question, what's the impact of the 8% salary increase upon the retirement systems? And the question, does the 8% raise impact the considerations associated with the 0% payroll assumption? I put that question to GRS. I thought first we ought to define what payroll growth is. Payroll change, that seems to be a common topic. I'm using this in the context of change. Payroll growth change is the change in the number of members, could be positive or negative, and the change in the average salary, could be positive or negative. So you put those two together and it says, that, let's just say the payroll was $1 and now it's $1.01, or now it's 99 cents. That would be the change in the payroll. What we've seen historically is a modest increase in average compensation, average salary, a bigger decrease, and this is what K-9 has, a bigger decrease in the number of members, active members. Active members have been going down about 4.5% a year for the last 7 years. It was 4.4, I think, last year, right in line with the trend. And compensation has been going up 2 to 3%. So we've been seeing payroll growth declining at about 2% a year for, I think it goes back 10 years, in fact, which prompted the House Bill 8. That was kind of one of the things that really drove House Bill 8. So the GRS's answer to the question is, does the 8% affect the interest their payroll assumption? Not immediately. Their point is, and I think we hear it over and over, the assumptions are intended to cover long periods of time. We have a 27-year period to write down this unfunded liability. So they're looking at longer periods of time. They do think that the 0% assumption is appropriate until such time as the experience begins to show to the contrary, and that active membership levels out or begins to rise. The longer as we keep seeing declines in active members, they're inclined not to move. I guess if the increase in compensation year after year after year continued at a high level, they'd have to reassess even if membership was going down. But that's the key that they're looking for. They do think they said upward assumption changes will be more likely if the pay raises help employers hire people, and we begin to see employment again flatten out or increase. What was the financial impact? Okay, for non-HAS, it affected the normal cost only. So the payroll went from, I think, I've got notes here, 134 million. The normal cost went from 134 million to 145 million, up about 11 million. Again, it's the only thing impacted the K-9 has is the normal cost. Normal cost is now 9.97%. Just dropped below 10% for the first time. So you got to pay the 10%. You got to pay the 9.9% on the increase, the 8% increase, and that amounts to $11 million. No increase on the unfunded liability because House Bill 8's already assigned that, so there's no need to compensate for that. I would say that House Bill 8, on an aside, did prevent a $29 million shortfall. Had we not had House Bill 8, the decline in the payroll, 2.8%, would have cost us $29 million in lost contributions. Okay, hazardous, they estimate, this is GRS, between 1 and 2 million. These are all GRS numbers, by the way. The state police, the $215 million appropriation dropped the contribution to just under 100% from 140. So we're going to get less money as a result of that, but because the state police kind of across the board have had a variety of ways of increasing compensation, we're going to get more money. And it's going to probably prove to be almost a wash. They're saying that the contribution was $45 million last year. It's probably going to be $49 to $51 million as a result of the 8% increase. So modest, relatively modest in all cases. Questions?
Representative Tipton.
Thank you, Mr. Chair. If I could ask a question off your assigned topic real quick. I had reviewed the last fiscal year, basically what the percentage of funding levels were. Do you all have updated numbers, what the funding levels are on each plan?
I have June 30 of 2021, but
that's the number that so y'all don't have anything updated on that?
No, we won't have until maybe a preliminary number in mid to late August.
Okay. All right, thank you.
Representative Graham.
I've got a question. Excuse me. And I guess this would be the time because you all may leave upon your presentation, and Bo is here. And I guess you all can answer this together, but I've met with some constituents who have worked in different agencies, which are now in different retirement systems. For example, they may have worked for the legislative, judicial area and then come into the state government area of employment. And I guess my question is, when you have an individual who transfers from one agency that's in a different retirement system, how do you determine the credit hours for the high five pay figures? And how do you resolve any errors that the individual who is transferred from one area to another, how do you resolve those errors or those miscalculations of those five highest years?
Sitting here, I don't know the answer to that.
Okay.
I'm looking for Bo to see if he.
And the other thing is, how do you determine how accurate those differences or those particular figures are when it comes to an individual who's about to retire? Yeah. And they may have paperwork that shows that it's different than what the agencies are providing to them. So can someone give me at least an answer or a possibility of an answer as to how that is resolved when an individual is about to retire and they've been in different retirement systems because they moved across the different agencies?
I could address that now.
Okay. I don't care. I just wanted to give that out to everybody, and I wanted everybody to be in the room before you left, and I was afraid that you all possibly had to leave, but I wanted all the agencies to or retirement systems to be able to answer that question in terms of the differences in the possibility of those last few years of them working within a state government agencies that's in a different retirement system.
Yeah, I think Bo's indicated he can answer that, and I think he's in a better position to do that.
Bo said, both Bo's, I think, will be able to answer that. So
Bo knows.
Bo knows. We know that.
Would you like to do it in our presentation?
Yeah, we don't have to do it now. If you want, unless it's up to you, Mr. Chairman. But I just wanted to put that out there to get some answers.
These gentlemen are about to wrap up. Let's let them finish, and we'll bring in TRS.
Thank you, Mr. Chairman.
Thank you.
We have no further prepared remarks.
Okay, now it's time. Co-Chair Higdon has some comments.
Thank you, Mr. Chairman. I appreciate that. And we passed House Bill 297, Representative Miller, very good bill, a cleanup bill that we discussed during the interim, and it contained a lot of issues that we discussed here in this committee. And so there were no surprises in it. A few things, the process works. A few things were added, a few things were subtracted. One thing, it was vetoed, and we overrode the veto, but in the governor's veto message, he was concerned about folks living outside the state of Kentucky and working for KPPA. Is there anything in state law that says our employees have to live within the state boundaries?
I'm not aware that it's in statute, no.
Have we ever had that an issue with someone living in Tennessee and driving to Kentucky and working? Or
yeah, I don't know across the whole state. I know at one point we had an employee in Pennsylvania, no longer works for us.
Did they commute back and forth?
No. My concern is about the governor's concern, because I think we're going to be faced with, and staffing in the investment area, we're faced with a limited amount of candidates, qualified candidates, and we may have to, we'll probably identify people that are outside who choose not to move. Period.
I think everyone's attitude has changes about remote working or working from home. I think COVID changed those things that kind of broke down that barrier. And when we discussed this during the interim, we openly discussed that you might hire an investment manager that lived in another state. Is that
right?
Correct?
Well, we have one right now. If you're looking at Stephen Herbert, he lives outside of Jacksonville, Florida.
Okay.
And he does come here on occasion. He comes here he has to pay his own way. He pays airfare and hotels, but that is the way the regulation works.
Okay. Well, just checking. That was our intent.
Yeah.
I
think we're going to face that.
Okay.
Yeah.
Another thing that House Bill 297 did, it added 4 new members to PPOB, 2 from the House, 2 from the Senate. And I think that's really a good idea. We need more legislators with an understanding of pensions, and I think that was our problem years ago, that a lot of it just wasn't a lot of understanding about the pension system, and we didn't have, I guess, the benefit of updated actuarial analysis and
I've raised the issue about doing a session early in the next General Assembly, maybe the first week, and open that we would talk about pensions to any legislator that wanted to attend.
I think that's a good idea, and we'll maybe we can schedule that during our first week. Also, one of the things that to this committee and to those that are involved is, pension reform or things that deal with the pension are major issues. And I don't think they need to be added on as amendments during the session. I think if you have a bill, if you're an interest group and you have a bill, KERS, CERS, TRS, State Police, whoever it is, League of Cities, KCO, any of the interest groups, if you have a bill that you want to pass next year, you should bring it forward to this committee and have some discussions about the bill before it comes to session and goes to state government. And but again, I don't like the idea of major legislation being added on as an amendment and not having a lot of time to discuss it. And most legislators like myself, our hazardous duty folks, we take a great, we want to help them. We don't want to be the bad guy and say no. But pension policy needs to be well vetted. And hopefully the members of this committee support that. And I'll get a letter out to leadership and the interest groups and say, if you have a bill for next year, please bring it to PPOB this year and let's discuss it. I feel, very strongly about that. And I think that prevents mistakes from happening. We have some issues, to quote James Allen Tipton, Representative Tipton, we'll be talking about pensions till Jesus comes back. So we need to have open and honest discussions about these things, and it is important. It's very important. We have discussions about COLAs. We have discussions about insurance. We have discussions about sick days. There's a lot of issues out there that need to be discussed. And like I said, not taking anything away from the state government committees. We have very capable chairmen, but it'd be good to discuss it here first. So thank you for hearing my rant. Mr. Chairman.
And Co-Chairman Higdon, I just want to second what you said. We've talked about this offline. And just for example, the firefighters pension bill that we did, nobody here would disagree with giving a firefighter that. However, it's not good policy knowing how improvements to benefits affects the pension systems that haven't been vetted. We should never be doing things like that. That's one of the reasons why we got in the position we got. We wanted to give out sick days. We wanted to give out high threes instead of high fives, and we did it without properly vetting things and understanding what that costs the system, the state, and how people should help pay for that, and what changes should be made. So going forward, I'm going to be gone from here, but going forward, it should absolutely be the policy of anybody wanting that done. So anybody who's listening, it needs to go through this committee and vet it and talk with the systems and understand what the true actuarial cost is, and not just what an annual cost is, but what the actuarial cost is. So I second what you had to say, and you're spot on.
Thank you, Mr. Chairman.
Senator Mills.
I'm going to do the same thing that Representative Duplessis just did. I agree wholeheartedly. We need to probably take another step, and whoever the new House State Government Chair is, and myself, we need to stand firm. And when somebody files a bill, it gets sent to our committee. If it hadn't been vetted, then we need to tell the bill sponsor that needs to come before the PPOB so we can get a clear understanding of what the cost is, long-term, short-term, and then we'll hear the bill after that. I think if Senator Higdon, if you're going to send a letter out, I would agree with that. Maybe we could all sign on it.
Absolutely. I think that's a good idea. Thank you. Sorry about that, Mr. Chairman. I didn't get permission to answer.
You're well within your rights. Any other thoughts or comments for this group?
I want to just say amen, amen, and amen. I would say this. I think when new classes come into the General Assembly, that they need to be introduced to the issue of the pensions. When they come for those, do they still do at least 2 days or 3 days orientation? You don't have to get into the weeds with them, but they need to be at least know a little bit before they really delve into it. But I think that would be one of those things that they ought to be presented when they come for their orientation. And then they have something planted, and they can start looking into that, particularly those who get on state government or A&R committees. But usually freshmen don't get on A&R. But it could be the exception to the rule. But I agree with my former seatmate, Senator Higdon.
Representative Wheatley.
Thank you, Mr. Chair. Many of the things that our co-chair brought up were very poignant, I thought, and I had a bill that came into the session last year that I very much will have as part of the interim, and look forward to doing that. And that you may have recognized it not being quite pushed as much last session, but it's a bit of a complicated bill, and there's more work that needs to be done on it, Brad and Jennifer, as I look around here. So I appreciate those comments, and the co-chair did bring up another issue related to the governor's veto of 297, and an issue that wasn't discussed too much, but I'm going to give Mr. Eager a chance to have a comment on the 4 to 6 employees, which we just talked about. And David, is there going to be any kind of guardrails, I guess, related to the salary range for these employees? And that's been a concern. It's been a concern of some things that have happened in the past.
Yeah, there certainly will be guardrails. It's the board's responsibility to approve positions. So the majority of those positions are full. 4 of those positions are full right now. 2 of them are already exempted. 2 more will be. One is a vacant position that needs to be. The board will approve that. And then there's a position that hasn't yet been defined that needs to be approved by the board. The executive director doesn't do that. And then the board sets salary ranges, minimum and maximum. Those are the guardrails. This will be discussed. I don't know that it'll be in the upcoming meeting at the end of this month, or a special meeting after, or the next KPPA. It's a KPPA decision. They'll set the guardrails. Then the executive director, whoever it is, can compensate within those guardrails. So if you have a vested interest in that topic, stay tuned because it may be discussed at the upcoming KPPA meeting.
Thank you. That's good to hear. Thank you.
But it'll be the board. It's going to be there are 8 people on the board, KPPA boards, 4 from C and 4 from K. They set it, and then the executive director has to live within it.
And all part of the fiduciary duty, actually.
Right.
Obviously. Thank you.
Now, I do want to point out, just in the interest of time, we are an hour and 20 minutes into the first session. Representative Miller has a question.
No, actually a comment. People keep saying these 4 to 6. It's 6 total.
Yeah.
Total. It's not 4. It's not. I guess you have 2 now.
Yes.
So it's 4 additional. So, saying, and I would endorse a Schickel rule for pensions. So.
Anything else? Gentlemen, thank you for your testimony and for your information. It's very appreciated.
Thank you.
Thank you.
Okay.
Thank you.
Bo Barnes of TRS. Sir, if you would come up and state your name for the record and give us your presentation.
Good afternoon. Bo Barnes. I serve as Deputy Executive Secretary and as the General Counsel for the Teachers Retirement System. And excuse me a second while I click out of here and find JFRS. Here we go. Are we up here, I guess? Yes. Okay. Okay, good. Yes. Good afternoon. Thank you for inviting us here today. We've been asked to cover a couple of topics this afternoon. The first of those is investment performance. There we go. And investment performance, these are unaudited returns I'll be sharing today for the period ending March 31st, 2022. And as we are all aware, this past quarter has been a very challenging quarter. A lot of uncertainty in this quarter with Russia's invasion of the Ukraine, with inflation, and, questions about what the Federal Reserve might do in response to that inflation. So a lot of challenges and uncertainty this quarter. And I'm going to share with you first the return numbers for the Retirement Annuity Trust or the Pension Fund, and then I'll do the Health Insurance Trust next. But even given those challenges and even given that uncertainty that we've had this past quarter, the market has proven itself to be pretty resilient, okay? And I'm going to go to the bottom left-hand number here, percentage, and you'll see negative 4.9% for the quarter. That's for the 3-month period, January 1st, 2022 to March 31st, 2022. So we had negative returns. Again, we knew that was going to happen before this quarter even ended, given everything that was going on. But with everything going on, with those challenges and level of uncertainty, that's not a major market correction at negative 4.9%. That is a market holding up pretty well under those challenges. Moving on down that row, and we don't have, at this point in time, because these are March 31st numbers, we don't have the benchmark quite yet or our Aon rank quite yet. So that's why those are missing. But moving on down that row, fiscal year to date, negative 0.67% return. 1 year, 4.76%, 3 year, 11.99%, 5 year, 10.4%, 10 year, 9.5%, 20 year, 7.26%, and 30-year at the bottom in the blue box, 30-year compounded gross return, 8.25%. And so for all of those long-term numbers, we remain above the assumed rate of return of 7.1%. Next, be moving to the health insurance chart, and it's the same format. And this again, the unaudited returns as of March 31st, 2022. And I'll move to the bottom lower left-hand corner percentage of negative 3.88%. So negative 3.88% for the quarter for that 3-month period. Fiscal year to date, 0.86% return, a positive for that 9-month period. 1 year, 7.17%. 3 year, 11.66%. 5 year, 9.88%. 10 year, 8.17%. And we don't have longer term numbers for this fund because, of course, it's a new fund. It really got established in 2010 with the enactment of shared responsibility. Okay. We've also been asked to talk about the same subject that KPPA was asked, and that's proxy voting and ESG, which is, of course, environmental, social, and governmental issues. So first, with proxy voting, we are similar. Well, let me back up. We do have a policy statement on proxy voting, which has been provided to the board. And the overriding policy tenet of our proxy voting is to protect the system's long-term financial interest. Okay? That is it. That, as our role as fiduciary, that's what we want to do paramount, and nothing else negates that, nothing else compromises that. So how does that work? Like KPPA, we do use Institutional Shareholder Services, ISS, which is the largest proxy voting company out there. And what they do, and they do a lot of things for institutional investors, but proxy voting is one of those. So they are looking at the proxies that are out there and the companies, that we own, and they are looking for, and they are making recommendations to TRS about those proxy votes and which way those votes should go to protect the long-term financial interest, okay, that we have. Those recommendations from ISS come to our internal investment staff, and they review those recommendations to make sure they feel that they do protect the system's long-term financial interest. And then we vote those proxy votes. We cast those votes with that goal in mind, okay? So that's how the proxy voting works. And again, we're looking for what protects the system's long-term financial interest. We also have the ESG, again, environmental, social, and governance issues. I know KPPA talked a little about the reporting and some of the things that are going on nationally, and rather be duplicative of that, I thought I'd focus this afternoon just on what TRS does with ESG. And TRS is not a ESG investor, okay? And we've provided a copy of the policies that TRS has on this matter. Again, we are fiduciaries. What our fundamental overriding tenet on all of our investing is the highest return within acceptable risk levels. That's what we're trying to do, is bring value to the portfolio. We, like KPPA, there have been a lot of things over the years we've seen where there have been attempts to have TRS divest in various companies. One of the biggest ones that I was involved in was the Sudan. That went on for several years. There were a couple of bills even filed that were not enacted and not advanced, but there were a couple of bills filed that would require at least review of divestment in companies that did business in the Sudan, which is a very tricky thing to do because a lot of those companies, for example, pharmaceutical companies, might be providing, important benefits, for that company. So how do you untangle that? How do you decide who's a bad actor and who's not? And it's really a difficult thing to do, but there was a big push for that several years ago. And granted, we're human beings at TRS, and we know that, like in the Sudan, there were atrocities being committed that were horrible, and we sympathize. But, and you'll see under our policy, we don't make foreign policy, for example, in this case. We look to federal government, the supremacy clause of the United States Constitution, for them, the State Department to make, that kind of policy. And that's not something that we wade into. Again, we're looking for the best value for returns within our acceptance for risk. So that's how we invest, and we're not an ESG investor. We are a fiduciary, and that's always first and foremost in everything that we do at TRS. I brought this slide up. This is an important slide, and this segues into the investments that we were just talking about.
Before we move on, Bo, let's just stop for just a second talking about proxy voting and possibly ESG. The question I posed to KPPA, what metric do you have to make sure that your proxy votes are aligned with your goals?
We have, within the policy statement that we handed out, there are some general guidelines. A lot of what you see, and probably really most of what you're going to see with proxy vote, not everything, there's a lot of other stuff in there too, but it's, electing board members, members to that board. So what you're looking for there, and you can see in our written guidelines, we like a board that's mostly independent, We also like that board to have some people who are not considered what deemed independent board members. They may be, involved in the day-to-day running of that corporation. But that's a good thing to have some expertise on that board. We just don't want them to be the majority of the board. We don't want the CEO to be the same person as the board chair. So we're looking for good governance, and that good governance brings about the kind of goals that we want, where they're really working to maximize, the best financial interest of that company, which then endows to us and our best financial interest. And we're avoiding conflicts of interest, for example, among members of that board, interests they may have with individual interests. So we are doing those sort of things, and we have those guidelines in the policy I handed out, as well as others. But,
well, I'm sorry to interrupt, and I agree with those goals. Those are great goals for that. But to use your example, for board members, that you want them all to be independent board members, free thinking, able to how do you know, as TRS, that the proxy that you've hired, ISS, is giving you their votes are based on independence and not on insiders that they would like to control that board?
Well, we review all those proxies. Every proxy that comes in, we'll see what it is, and then we'll have the ability to cast a vote on that. And then those proxies are reviewed. And again, usually, you're going to see something like the qualifications of an existing board member that's being reappointed. There haven't been issues with that board member. There's not any complaints filed against that board member with the SEC or otherwise. We're looking for good governance constantly. And it goes before that as well. So before we, when we pick managers and when our managers are picking companies to invest in, governance is very important. So usually when you are picking a company, you are looking, well, not usually, always when you are looking to invest in a company, or managers looking to invest in a company, they're looking not just on what their business model is, but what's their governance. Do they have good governance? Do they abide by state or the federal law? Do they avoid conflict of interest? Do they like that model? If there's any red flags with that board model, then that's when we're going to avoid investing in that company. And so we're getting into these companies on the front end because initially they have shown a track record of being well-run companies, in complete conformance.
I don't think that's my question. My question, Bo, is if you as a board tell ISS that for this particular vote, this is what we would like to see, do you follow up to see if it got voted the way that you wanted it done?
Well, and I'm sorry, I may have explained it. We cast those votes. ISS just makes recommendations to us and provides some information for us to look at, and then TRS actually casts the vote.
Okay.
There is a recommendation, but we actually, it comes from our office.
Okay. All right. Thank you. Auditor Harmon.
Thank you, Mr. Chairman. Bo, thank you for bringing this information. I appreciate your explanation. First, what's the total amount that we have invested currently?
Okay. We have, let's see, so June 30th of last year, and it's going to be close to that because those fiscal year-to-date numbers I gave you,
yes.
For retirement annuity trust is a negative 4.9% decline, roughly,
right.
And a negative, I think it was 3.
Just ballpark.
Yeah, so probably a little under $26 billion in retirement annuity trust and a little under $2.3 billion in the health insurance trust. It's those were the higher numbers at June 30th. So,
right.
$24 billion maybe. A little less than $2 billion, maybe right around $2 billion though.
Well, and I appreciate that. I appreciate your comment on the ESG as well. I probably didn't make myself as clear in the previous questions with KPPA, but I mean, from the standpoint, if I'm investing my money, then I can. If I want to invest for ESG, I can. If you want to invest your personal money, you can. But the dollars that we, or as a board, or you as a board, are investing, obviously, those have to be for the best and the benefit, the fiduciary responsibilities. And so I appreciate you doing that. Your explanation of the proxy services was a little different than KPPA. That their testimony seemed to indicate that they gave them their policy statements and then they actually voted it for them. But from what you're saying is that you all receive the recommendations and then you make a decision whether to vote in favor or against or remain neutral on such things. Is that a fair assessment?
Yes, we cast those votes in-house, yes. Based, we look at the recommendations and information that we get from ISS.
Are you hearing or seeing any pressures to vote more in an ESG, sometimes in disagreement with the fiduciary responsibilities, and how are you all handling any such pressures if they do in fact exist?
We're not really getting that. Our for example, our managers out there that we invest with, we don't want social investors. We want people who are going to bring us the most value. So we're not really having that as an issue. We are aware that is an issue out there in places in the country. We are aware of that there are maybe, and I couldn't quantify this, but there have been some large institutional investors out there that have chosen an ESG approach. But that is something that at TRS we are firmly against. I mean, we have to live up. We have to adhere to our fiduciary responsibility, and that's just so important. Our trustees get training on what it is to be a fiduciary. They hear it every single year, but we do it every single year, if not more often in investment committee meetings, for example, about the importance of bringing value for our members, which in turn brings value and savings for Kentucky's taxpayers.
Thank you. Thank you, Mr. Chairman.
Yes, Mr. Chair. So I really wanted to discuss the budget that was just enacted because it was a phenomenal budget. We are TRS, and I know teachers are extremely appreciative of this budget that was just passed out. And I'm just going to go over very quick. And again, this ties back in to investing because with the additional funding that we're getting now, we are able to invest better. We're able to not avoid certain investments we had to avoid before. We're able to take advantage of opportunities that maybe we couldn't take advantage of before. But the budget that was just enacted in the 22 session, this marks the 8th straight year of full or very near full funding for TRS. And when I say nearly full funding, I'm talking about maybe 97% and 99% in the 2 first years of this. So really full funding, okay? So again, game changer for us. It's a wonderful, it's meant a lot to the system. It's ability to invest and to implement its funding plan, to pay off that legacy unfunded liability, which we're on track to do. We got a little under 24 years left in that amortization schedule to fully implement that funding schedule, get us to 100% funded, at which time our cost to the state will be a little bit less than Social Security in today's dollars. Just a few more numbers here. Over $1.3 billion in both years to meet that additional contribution needed for ADEC so we can fully implement that funding policy. There's about another $900 million over the next 2 years that come for the Department of Education SEEK formula for that fixed statutory contribution rate. Under health insurance, the state's portion of under 65 health insurance, completely funded at $149 million over the next 2 years. These next two, explain these just a little bit. We've talked about it here before this board several times. Maybe not everyone who's listening has heard this, but we have something that was sometimes colloquially referred to as the green box dollars. And that reflected payments on an amortized basis for some past benefit adjustments that were awarded years ago, or even more currently for sick leave. For example, one's cost of living adjustment. Years ago, when budgets were better, funding was available for a cost of living adjustment over the fixed 1.5% that teachers get every year. And that hadn't happened since 2008. But when that happened, when there was additional funding, and no COLAs were provided without funding, then the state at some point moved away from paying those sort of in a lump sum to paying the costs for those new retirees' COLAs, or for those COLAs. Instead of paying those off in lump sum, they started paying them over a period of years. I think it started at maybe 10 years and it grew to 20 years. And then the other thing was sick leave, okay? Sick leave, instead of being paid those retired teachers as they're retiring, the cost of their sick leave, it was being paid for over a period of years, and that had grown to 20-year periods too. So we had this balance sheet of all these amortized streams of payments that were being made to TRS over a period of years with interest, okay? So TRS was not out anything, but then the Commonwealth took a look at that and in its budget made the policy decision, we're just going to pay that off, stop paying interest, and pay those past benefit adjustments in full. And so that's what the $479.2 million is that was provided in this current budget to pay those off.
Well, let me just stop you for a minute. I didn't do my co-chair any favors. He had a question way back on one of the earlier bullets, and
sure.
We got way into your $479 million. You might need to recap some of that.
Yes, sir.
If you would, Co-Chair Higdon, if you would ask your questions.
Thank you, Mr. Chairman. Back up at the $900 million. It says about $900 million more to TRS in salary contributions. Is that additional payroll, or is that pay raises? Where did 900? That would be about 3% of payroll, correct?
What we have there, and the reason that's split out is we have items that are in the TRS budget request that we present, to the executive branch and to the General Assembly. And then there's some of the money we get doesn't come of our budget request. It comes through the KDE, the Department of Education budget request. And that is for the state makes the contribution, that fixed contribution for teachers on their salary, that 13.105%. So that's what that is. It goes through the SEEK formula, but we kind of break it down because you won't see that number in our budget request because it comes through KDE. We work with KDE. They ask us questions, but they actually come up with that number and make that request. So that's that fixed statutory amount.
Okay. Thank you, Mr. Chairman.
Okay. Bo, please get back on. Sorry about that,
Sure.
Chair Higdon. Back to your discussion about sick leave.
Well, this was that next to last bullet point, and so instead of having these streams of payment that we're receiving over years and years, and will continue out into the future, for years, the Commonwealth made a decision, and the Commonwealth paying interest on that at 7.1% now. The Commonwealth made the decision, we're just going to go ahead and pay this off in lump sum. So that's what that amount reflects paying off all those past liabilities today, now, in full.
And I'd like just to explain to anybody who's listening that saves the state a compounding interest of 7.5%.
Yes, sir.
And so it's a good thing for the state. It costs us a lump of money up front, but for the state taxpayer, it's a 7.5%.
Yes.
Long-term comprehensive savings.
Yeah.
It's kind of like thinking of a house mortgage. If you had a house mortgage at 7.5%, that's not a good house mortgage. You're paying a lot of interest at 7.5%. So by paying that up front, we basically paid off this mortgage, saving a lot of compounded interest. Representative Tipton.
Thank you, and I'll give a pat on the back to the PBOB because the spark that initiated this policy decision started in policy discussions here with Bo and TRS, and we took that to our A&R folks and were able to see that through in the budget. And I believe we were paying payments of around $70 million, so we'll be saving the taxpayers about $30 million a year, roughly. I think it's close. Yes. On the health insurance fund, I know we're getting closer and closer to the 100%, and I will have a follow up to this, Mr. Chair. Do you have a projection now? Two-part question: a projection on, and maybe you need to do some research on this, on when we might get to that 100%, and when we get to 100%, what will the normal cost be to keep that funded at that point in time?
Yeah. So it is. We are getting very, very close, and that's great news that we are getting that health insurance trust close to 100% funded. And as we've discussed here, that's a good thing, for a couple of reasons. One, we would be getting more in for the health insurance benefit than we need. So that means that, there can be reductions in that payment savings, okay? And then second, very importantly, being so close to getting that 100% funded and getting there, actually. If anything does happen with medical inflation or anything else, when you're 100% funded, it's a lot easier to fix than when you're 60% funded, which we were June 30th, but we are moving very strongly, and we will have that health insurance trust funded fully in a few years. I mean, we're talking about single digits. There's some things going on right now, national health scene with, inflation, what's going to be happening with Medicare Part B because our active teachers our retired teachers under 65, they pay that Part B premium out, which went up quite a bit this year. We're going to see what ultimately happens with that, but that could change the dynamics a little bit. But we're within just a matter of years. We're in before the end of this current decade. Having that fully funded.
If I could follow up, of course, teachers pay in 3.75 into that. The state pays in the 0.75, and the local school district pays 3%. And I believe, I'm looking through the budget, I believe I'm correct. The state actually sends the money in a line item to the school districts to pay their share of the 3%. I believe I'm correct in that.
It could be. I know the Commonwealth pays the cost of health insurance for active teachers. That's my understanding.
I believe it's a specific line item in the budget, and it's a pass-through to the local districts to pay for that. So we've got a total of 7.5% going into that, and hopefully down the road it won't take that much contribution to keep the fund going. And like you say, we could take a look at what we need to do going forward when that time comes, hopefully very soon.
Yes, sir.
Representative Miller. Oh, I'm sorry. I thought you had your hand up. Okay. Anybody else? Bo, you can continue. Senator Mills, go ahead.
Okay. The last bullet point item, we had quite a bit of discussion about sick leave the last meeting of PPOB, but as those teachers retire every year with sick leave, we know how many there are. We know how much sick leave they have, and how much it increases their retirement benefit. There is in the budget an assessment for the cost of that crop of retiring teachers, every budget. And, this is like those old supplemental COLAs, over and above the 1.5%, which, I haven't had since 2008. But the Commonwealth years ago, I'm talking about like probably 1998, instead of paying the full cost for those teachers who are retiring every year, was amortizing that cost over a 20-year period. So not only did that $479.2 million pay for all the old cost for those retiring teachers for sick leave and the old supplemental COLAs, it also now is paying the full amount for those teachers who are retiring every year for their added sick leave liabilities, instead of paying that over a period of time. So that's not only has the Commonwealth paid off these past liabilities, they are now paying fully every year, so that going forward, because COLAs are gone now, the liability of those old supplemental COLAs are gone with the $479.2 million, and the sick leave is going to be paid for these retiring group of active teachers every year. Will be paid in each budget. Now, we do have active teacher liability, which came up when we discussed that last session. That's part of the ADEC that we are getting, is to address active teacher, the normal cost, and their liability for sick leave. And that is being captured as well, just in that general ADEC budget request, the additional supplemental funding we're asking for. It's not broken out as a separate line item in that budget request, but it is part of that budget request, like so many other things have a part of that. There's a cost for disability. There's even a tiny cost for life insurance. So that is being captured as well.
Okay. You lost me there just at the end.
Okay.
I was following you. Good. So the 479.2 was, we paid off all past green box dollars.
Yes, sir.
Correct. The 78 million, are we prepaying for 2 years of sick leave? Is that what the 78 million is?
What that does, okay, there are a couple ways that the full cost of sick leave is being captured. We have the cost for our retired teachers, and we have the cost for our active teachers who have not yet retired, but there is some liability already assigned to them because they're so far in their career. They have so many annual leave days accrued, right. So there's a cost for them too. The $78 million gets to the actuarial cost for each, I would say, retiring class of teachers. So we're paying for their cost, the liabilities assigned for their use for sick leave. This is one part of the sick leave cost. The other part, and again, two different camps, a retired teacher camp, to kind of simplify and put this in simplistic terms, and then the active teacher camp. The active teacher camp is something different from the $78 million, and that's what is part of the additional funding we're receiving.
Okay, so the active teachers' contribution is involved in the ADEC. The retired teachers is the $78 million.
Yes, it's a separate line item. It's a specific separate line item. Yes, in the budget.
Okay.
Budget request.
All right. I think I got it. Thanks.
Thank you. And Co-Chair Higdon.
Thank you, Mr. Chairman. I want to try to, of course, the $479 million green box dollars, we won't hear any more ever again about green box dollars, right?
I wouldn't think so.
Well, that's good.
But no, they're done.
They've come and gone for years. We concentrate on them, then we don't. So they're gone.
Yes, sir.
All right, mark that color off our chart.
Yes, sir.
All right, the $78 million. Now, our newly discovered number that we talked about, I think last month's meeting, the $534 million of current liability, sick day liability for current teachers. We have that amount. The $78 million is for the teachers that retire, newly retired. This is paying in full up front for them instead of amortizing it.
Yes, sir.
Okay. Now, and we're also in the ADEC. There's also money going toward this $534 million liability.
Yes, part of the ADEC amount includes this active teacher liability. Yes, sir.
That's about $50 million, I think you said last.
I believe so. Yes, sir.
So we have $534 million. We're amortizing the ones that retired to pay for that again, it almost seems like again because we're amortizing it before they retire. Does that $534 million, does it ever get to zero if we're paying $50 million a year toward the AID Act?
Yeah, so the amount we're getting is for the normal cost of that sick leave plus the unfunded liability portion of that. So the goal is to pay off, the unfunded liability portion and just get to normal cost. As I understand the actuaries, is ultimately just to get to normal cost of sick leave.
Okay,
which is kind of like a regular pension contribution. Part of that is just normal costs that we would get from now for foreseeably into the perpetuity. Part of that, and the greatest part of that, is unfunded liability. So we're getting both. For example, in the pension contribution, or whatever the normal cost is, how much we have to put away each year. So when that teacher retires, we know we can pay for their benefits. But then we have the additional cost that's part of that total ADEC, which is let's retire this unfunded liability and get it 100% funded. Same thing with active teacher sick leave.
Ma'am, can proceed, Mr. Chairman.
Real quick, so just, yes, you may. But
No,
let me ask, so sick leave has a normal cost associated with it, but when it was instituted years ago, I think you mentioned 1998, that normal cost was never added to anybody's, to what people were paying into the system?
I can't speak for that long. And this actually, sick leave came about in the 80s. I looked, and it came about in the 80s. And I'm not sure what happened, and certainly that preceded my time. It could be that with the new statute, it was discretionary with the school districts whether or not they even had to make lump sum payments for unused sick leave. They didn't have to. They didn't have to do 30% of the daily rate. They could do 10% of the daily rate. And, of course, that's a KDE statute, Department of Education statute. So as we've discussed before this board, it's outside the inviolable contract. So I don't know if perhaps for those reasons that, they might have been capturing normal costs, but I'm not sure what happened. That was with the our prior actuary, not our current actuary, when that came about. I know they had concerns about capturing the cost because I saw a letter. So I think they were capturing normal costs. I think that then became a normal budget item. I don't think, and again, this is before my time, I don't think they were then trying to capture the unfunded liability that would be growing from that. But I don't know. I'm really conjecturing going back that far.
It's what it seems to be. Senator Higdon, did you have a follow-up?
I do. I'm still confused, Bo. I understand the 78 million. That's 39 million in each year for those teachers that are retiring, the sick days. Now, and this is the liability, the pension liability. The sick days are already paid for at the local level when they retire. This is the pension liability of those sick days, correct?
Correct.
Okay. So the 78 million, that's prepaying in advance for those sick days for that teacher going forward as they retire.
Yes, as I understand from the actuary, that is paying the cost for those teachers as they retire, yes.
Okay. Now, we have the $534 million that you've set aside as a current liability for current teachers. And we're paying $50 million a year on that liability.
And then that's for the normal cost and the unfunded liability, yes, sir.
And so I guess I'm confused is that number reducing or is it remain constant? I'm confused at that point.
No, it is not reducing year by year. It can go up or down just depending on experience, but it's eventually at some point when the unfunded liability is paid off, then it would go down.
Okay. Maybe sometime you can give us a flow chart or something and give it a name. Not green box though. give us a name so we can better understand that how that works, because this is something that we didn't know, I think, until it was last month or the month before we asked you about that unfunded liability for current teachers. I don't think we ever discussed that prior to to last month. So it's something I'd like to get my arms around. Now that Green Box is gone, we can start working on these dollars.
Okay. Yes, sir. Yes, sir.
And go ahead with other questions. I have a follow-up in a little bit. Okay. I don't want to. Last month we asked you about annual sick days and annual leave being converted to sick days.
Yes.
And I think also full-time employees and just part-time employees accumulate sick days. And do you have a report for us on that?
Yes, sir. So we checked, and we have some non-school district employers, like Department of Education. Not very many. I mean, most of our field of membership is school districts. 95%, is school districts. So I think the question really revolved around school districts. Do we have annual leave in school districts rolling over into sick leave? And so I checked. I had our director of member services check, and there are 2 districts that are doing that. Kind of like state government agencies do. We have 2 school districts that allow unused annual leave that's in excess of a certain amount to roll over into sick leave. And then also on your other question.
Which districts are those?
Boy, I don't know off the top of my head, but I can find out for you. Be glad to.
We need to know that.
Okay, yes, sir. And we had one co-op, which is not really a school district, but we did have one educational cooperative. Be glad to do that for you.
We need to know more about that, because that's creating an unfunded liability for us, and there was never an intent to take care of those annual leave or anything other than sick days in that formula. So, and eventually, like to see a breakdown of how many days are they actually? What is that actually costing us? Because it's important that we get a grasp on that expense, because it is an expense to the pension system.
I will have those. I'll find out what those districts are, and I'll have you an answer by tomorrow at the latest. I just need to find someone who collected this data for me. Okay.
So let me add to your list, if you don't mind. I know you, as you said, 95% of it's school districts, but we have some governmental agencies, KDE, what have you, that could be in TRS too, correct? So
yeah.
Could you verify if they're allowing personal time to be converted into sick time pay as well, please?
I can tell you they would be, because KDE, like other state agencies, are under the personnel cabinet, and there are regulations in place that talk about conversion of annual leave to sick time. You can accumulate, and it depends on how many years of service you have, but I think at 20 years and above of service, the max annual days that you can hold on to at the end of each year is 60 annual days, and then anything by that, by administrative regulation, is required to roll over as sick leave. You can't keep it as annual leave anymore. So that would be the same for all state agencies under the Personnel Cabinet's guidelines.
So they could have pretty significant sized retirement sick day payouts, correct?
If you have folks that are not using their annual leave, then you can have quite a few, roll over into sick leave. I will say, and I know this board's probably aware, but just in case, annual leave for retirement calculation purposes ended for individuals who became members on or after July 1st, 2008. So no more annual leave goes in retirement, no more comp leave, just basically your salary. Also, in regard to sick leave, the number of days was capped for retirement purposes at 300 for people who became members on or after July 1st, 2008. And you have some folks who work a long time and are healthy that have a lot of sick leave days. And then also, even more importantly, this new tier that we have that became effective January 1st under House Bill 258, these new tier members who we're getting now, they don't get to use sick leave at all for retirement calculation purposes. So that the Commonwealth has walled that off. That has now ended.
Yeah, I knew the new tier was corrected, but KDE could have some six-figure salary folks making some significant. My issue with this is if somebody works as a teacher for 20 years, making $30,000, $40,000, $50,000, $60,000, but then they work 3 to 5 years as a superintendent or as KDE or something, making a six-figure salary. they get a pretty nice bump, especially if your vacation time is considered sick time, and the sick time is paid on your last salary, which could be a six-figure salary, not a $40,000 salary like you had not used that sick day time on. Does that make sense?
One more thing I do need to make sure I'm clear about that. I don't want to mislead anyone, but it's just to be clear. The use of sick leave, that lump sum payment at 30% of the daily rate at retirement, and using that lump sum payment to increase salary, your last annual salary for retirement calculation purposes, only school districts can do that, okay? For KDE and for other employers, and I believe this is true for all state employers, it's added as, in fact I know it is, it's added as service credit. So if you retire with 100 unused sick days, you don't lose those days. Those 100 sick days are added as service credit. So if you retire with 30 years, you now have 30 years and 100 days of service credit.
So you're not paid for those sick days.
No, it's just applied as additional days worked.
So you don't get the 30% payoff, like.
No, that only is possible in the school districts.
Okay, thank you.
Multiplier, couldn't those service days bump you up?
For TRS, we're very restrictive about what we allow for that multiplier, and it's got to be worked days, essentially. Okay. For us, accumulated sick leave days, if you're 100 days short of meeting retirement conditions, you can't use your 100 days of sick leave to get there. You have to actually meet those retirement conditions independently, and you can't use it to bump up with a higher multiplier. That's a great question, though. We specifically addressed that because we felt 3% multipliers reward days worked.
Any questions? Co-Chair Higdon.
Thank you, Mr. Chairman. And of course, I guess in teachers' retirement years ago, we did service credit versus the sick days. Correct. Years ago, service credit was an option for local school boards to do that. And then we transitioned into sick days.
It could be those service credit would still be an option with the districts. It's available to all employers, but they have to. It's voluntary. So a district could say, "I don't want to do salary credit anymore. I want to do service credit." But the statute says the employer has to pay the actual cost of sick leave as service, as opposed to salary credit.
Okay. One other question, and again, going back to last month was the month prior, that was the first time we knew that about this $534 million sick day liability that for current teachers. Is the board aware of that? Did the board understand that liability is out there? Did they know that?
It is part of the overall liability that's in all the actual aerial reports, just like there are a lot of other liabilities. A portion of that liability is for disability. There's a cost to that. They have an idea of the assignment for that. But have we discussed that specifically? They know about sick leave. We've talked about sick leave. Do they know that part of the overall liability is active teacher sick leave? I don't know if we've discussed that.
Well, again, back to our discussions here, we've always discussed those green box dollars for years, but just until here recently understood that there was also a liability designated for current teachers. So I think transparency is good stuff. Everybody needs to understand exactly where we're at and how this all works.
And we just have so much actual information that we give the board. They get the annual evaluations, they get reports by the actuaries, they get separate presentations, PowerPoints. They get a deluge of information. So I hate to say specifically they've had this or not that, but that they do get a lot of information about what is going on actually with the system, what the liabilities are, and the plan to pay them off.
Okay, we have one short question.
Short question. Could you do a narrative on where this 534 comes from? I'm trying to get my hands around it because I thought the sick day liability is for the sick day pay that's added to the high 3 at the end of retirement, from retirement until they pass away. I thought that's what the sick That's what the green box dollars was about. Is this 534 something else related to sick days?
It's all sick. It's all sick leave. Okay, so part of that 479.2 does represent costs for sick leave. Okay, and that is, again, it's when teachers are retiring. The actuary is providing us with a cost for those retiring teachers, how much needs to be provided actuarially to pay for the cost of them retiring.
Right.
And that's almost a pay-as-you-go kind of thing. You know, it's and in addition to that, that's not the full cost of sick leave when you take into consideration not just those retiring teachers each year, but you're taking into consideration the active teachers out there who have not yet retired. Okay. And they have a liability, just like they have a liability for the pension. Even they might have 5 years of service, but there will be some liability assigned to them because, you know, they could just go away and come back and, 40 years and retire that account. So there's some liability assigned to all benefits for active teachers in addition to retired teachers. And so that $530 million addresses the liability for active teachers that are out there in regard to sick leave, to continued use of sick leave.
I think we'll all get there. We're all struggling with this. If you can't tell, I mean, it's hard to understand.
And I apologize. I'm not doing a better job explaining it. I understand. Actuarial. These concepts are sometimes not the easiest thing to explain.
Well, part of it's because we didn't learn about the money until recently, really.
Yeah.
This was a new thing that we didn't understand until just recently. That was, I won't say it was kept from us, but it was something we didn't know. So it is somewhat new to us, so it's understandable. Other questions? Okay, Bo, thank you for your testimony. I guess there was a few follow-up items. I hope you got those down. If you didn't,
we'll get you those two school districts here very, very shortly. I'll send that to staff so that they can share that with the rest of the board.
Thank you. Appreciate you.
Okay, thank you.
And last but not least, Bo, I let you go first last time, didn't I? So. Bo, if you would, just state your name and for the record, and please present your presentation.
Awesome. My name is Bo Craycraft. I'm the Executive Director at Judicial Forum Retirement System. It's good to be here. And I don't mind. I learn a lot, so good meeting. Wanted to open up first by just one more time publicly thanking Senator Higdon and Representative Miller and the rest of you all for helping us pass a housekeeping bill during the regular session. Much appreciated. So just wanted to start off with that. Also, just to speak quickly to Representative Graham's question with regards to reciprocity. In our case, JRP does not have reciprocity with regards to salary. Statute defines that as the last 60 months of judicial service. So there is no need, even if they have an account with KPPA or LRP or TRS, it's based solely on the salary in that system. LRP does have reciprocity with other plans, and so subject to some pension spiking provisions. And in those cases, we verify and certify service and salary from that plan. And then those, in the case of LRP, it's a high 3. So if that high 3 occurs in another plan, we get that certified from that other plan along with the service to verify that they're eligible to retire, and then calculate the benefits on that.
They will send that information to the agency that the person is currently under. Or not to the agency, but to the retirement system that they're currently under.
Yeah.
And so from that, you base that upon that information that has been provided.
Right. So let's use an example of a judge who was a judge with us. Their pension is based off their judicial salary. But let's assume they leave the bench and go work in the executive branch. Or they, in our case, some have worked in as a county attorney or a prosecutor prior to becoming a judge. KPPA will ask us to certify their salary information and service. and we provide that information to KPPA staff, and then they calculate the KPPA benefit. We just do it the opposite with our legislators. If they go to the executive branch, then we get we certify what the salaries were and the service from KPPA, and then use that information to calculate the benefits.
Okay. All right. So in terms of, the calculations is based upon what the other agency they work for, the other system they were in.
Right.
And based from that, then you all make that, or whoever makes that determination.
Right.
In regards to where they would be.
Correct.
So are there instances where there is a discrepancy between what the individual has from paperwork that was given to them earlier versus paperwork that is now in the system?
When you say earlier, are you talking about
when they were working from? Yes, retirement. That's what
I mean. There's a likelihood that could happen, right? I mean, salary increases occur, and so if for instance, we're doing a lot of projections right now for judges, and they're all set to retire December 31st, but they're likely to get an 8% increase July 1. So their final compensation is going to change, and so therefore their ultimate benefit would change. But we try to clearly identify what's a projection, and then at retirement, I can think of a couple of cases where we've retired a legislator. We're using a high 3 salary. Your all's terms end on 12/31.
Right.
We won't get 2021 or 22 salary information until the middle of January after you've retired. In those cases, what we say, here's your benefit based on your high 3. If your 2022 salary becomes one of your high 3, then we recalculate that, and you'll get whatever the difference is.
They will include that last month that you didn't get.
Yeah.
So I guess from the standpoint, I think you've answered all of the things that I questioned. But if there is a discrepancy, is there a process by which, if they have information that shows a different thing and the system has something different, is there a process by which you resolve this?
I haven't personally had one.
Okay.
So, all of our salary information is generally coming out of Chris, right?
Okay.
I mean, it's flowing through. Contribution data is flowing through. KPPA, I assume, is probably more, automated than us, with the new line of business project. But I think you'd have to try to get to, ultimately the personnel department is generally cutting the payroll, and I think there would have to be some process. I just haven't had to work on one.
Right. I guess my concern is that now everything is done electronically, whereas people who started, who are my age and older, started and everything was processed by hand. The possibility of numbers being inverted in different directions,
for sure,
could have an impact on. I don't know. I'm just asking those questions because I was asked.
Yeah, they're good questions, and I mean, I can confirm that things were handwritten in the Judicial Forum Retirement Office. I've been working through we're scanning and trying to update our documents, and so there was much that was not automated. But I think in those situations we would try to, get data the best we could from personnel, from Chris records, and then from our own records, and try to make a decision, and there should be W-2s and those type of things, hopefully,
Well, yeah, and there were when I talked to an individual who I also dealt with a couple of individuals in terms of what their W-2 stated also did not correlate with what was done in the process of them changing from one agency and going into another.
Okay.
But anyway, I appreciate you at least, and maybe if you can, or you or Bo, since Bo knows, either one of you know, both of you know well. So if you could get back with me and send me something in regards to what you have said today, so that I can send it on to those who were asking the question. I appreciate it.
Okay.
Thank you, Mr. Chairman, for that opportunity.
Yes, sir. And the hour is late, so I
know.
encourage you to.
Real quickly, just investment performance. I'm not going to spend a ton of time. Much like the comments you heard earlier, fiscal year to date returns are right around 2.5%, depending on the plan. Last quarter was pretty difficult. And as you can see over the 1 year, 8.5%. We're currently slightly trailing our benchmark. Just to refresh you, we have a large cap equity portfolio of about 25 names, 26 names, and then we have a fixed income. It's a short duration, mostly almost all corporates. The equity markets just struggled with all the Ukraine, Russia, and then also inflationary concerns. Longer term, we're still above benchmark, strong returns, and so hopefully things will stabilize. With regards to the ESG, real quick, I want to spend just a minute on here. Our point of view is a little bit different, mostly because when you start talking about ESG, a lot of the conversation is outside the U.S. Start talking about divesting from certain countries or divesting from certain political issues. We're fully invested in the United States, so our lens of ESG changes just a little bit. And so when we think about ESG, we don't think about it as, first and foremost, our board is not in support of, mandated divestment. We want to be able to give our investment managers the ability to choose companies that they think are attractive and will provide a long-term return. But that being said, the partnership that we have with Baird, the overall emphasis on being what we call better business citizens is not a bad thing either. Our strategy through Baird is to try to be long-term business holders. When you look at our portfolio of 25, 26 names, there's multiple companies that Baird has owned for 20 plus years. Home Depot is one of them. We just talked about it's struggling a little bit in the near term, but it's been in the portfolio for 20 years. And so the idea is that if you or I were going to start a local business in Frankfort, Kentucky, we would want to be good corporate citizens. We want to be good to our customers. We want to be good to our city. We want to be good to the places that we live, because we want to be around for a really long time. And so what ends up happening is we're not ESG investors. Baird would tell you they're not ESG investors, but a lot of times the two things align, right? We're trying to create shareholder value and returns for the pension plan, but at the same time, we're finding companies that have solid management teams that treat their employees well, who are trying to be, environmentally conscious and use sustainable materials when they can. And so they align. And so not everything in our portfolio rates real well on an ESG scoring sheet, but a lot of our companies do. And so we wouldn't consider ourselves ESG, but we do want to consider our, being good business and corporate citizens. And I think a lot of that is because we are invested in the places that we live too. And so we don't currently have a policy. We're a single source investment structure with Baird Trust managing all of our assets. And so we're not requiring them to screen any potential investments based on any socially conscious factors. But again, the strategy itself is aiming to find high quality companies that are going to be around for a very long time. And so our portfolio generally does include a lot of those companies. And I included a letter from Baird Trust in your packet. And on the second page, it just talks about some of the impacts that several of their companies have had over the last couple of years, where they've made what we would consider short-term financial sacrifices, but with a very long-term point of view. And that would be things they did for their employees. Some of the banks did some debt forgiveness, short-term debt forgiveness through the pandemic and those type of things, but they believe will create value long-term as that is rewarded. As it relates to proxy voting, as a single source manager, we don't currently vote any proxies in-house. TRS and KRS didn't mention this, and I don't want to speak on their behalf, but I know in the past, they have generally only voted the stocks that they hold in their internal portfolio. For managers that have full discretion over their portfolios, they also have the responsibility for proxy voting. And generally, it's because they're the ones choosing the companies. They're the ones that are a lot of times investing in management. And so our structure is similar to that. We've partnered with Baird. Baird votes all of our meetings. They utilize a third party, not ISS. They use what is probably the second largest provider called Glass Lewis. And Glass Lewis does execute the trades, But they do have a copy of Baird's portfolio, and so any trade that is different between the two policies comes to the desk of one of our portfolio managers, and he looks at that individually. His name is John Watkins, and he's a member of the large cap equity team. There are ESG related things. I'll give you an example of one that was actually just mentioned at our board meeting on Friday. Berkshire Hathaway is probably, I think it's one of our top 5 holdings. Warren Buffett is very well known. He dabbles in energy. There was a shareholder proposal for his company to draft some type of environmental report. There was a push for that from a lot of your socially aware type, shareholder groups. Glass Lewis's position was yes, that you should approve that. Baird's position was no. They believe, Warren Buffett is the best asset allocator in the world, so why would we ask him to start writing environmental reports? And he also already puts out a ton of information about their consumption and their sustainability. And so to Baird, it just felt like an unneeded additional requirement, and so they voted in opposition of that proposal. And so, we have 25 stocks. Baird is managing our money along with a number of other clients. And so they can be a little bit more hands-on than, if we were holding a S&P 500 index fund and voting 500 securities. But that's currently our setup with regards to proxy. Hilliard does have a proxy voting policy, and they do also, like I said, utilize the supplemental research from Glass Lewis, which is just it's a very similar setup to ISS. With that, I'd be glad to answer any questions.
I'm thinking you finished up. So with that, this meeting is adjourned.